It was the house of cards that built a city, a shimmering illusion of profit and innovation that masked a vortex of fraud and corruption. Enron Corporation, once the seventh largest company in America, the darling of Wall Street, the very symbol of the new millennium's new economy, imploded in a spectacular cascade of deceit in late 2001, taking with it the life savings of its employees and the credibility of the entire accounting industry. The Enron scandal was not just a collapse. It was a complete systemic failure of regulatory oversight, corporate ethics, and financial journalism, a crime of such breathtaking scale that it vaporized over $74 billion in shareholder wealth in a matter of months. The story of Enron is the story of a company that believed it was too smart for the rules. Led by the charismatic CEO Jeff Skilling and the visionary chairman Kenneth Lay, Enron had reinvented itself from a dull pipeline company into a global trading powerhouse, a creator of markets for everything from natural gas to broadband internet bandwidth. The company's culture was one of extreme arrogance. They believed that they had discovered a new form of business, one that could generate limitless profits by trading contracts or derivatives for energy products. The problem was that these contracts were virtual, not physical. They were bets on the future price of electricity or gas, and Enron was booking the estimated profit from these bets the moment the contract was signed, not when the money was actually delivered. This was the mark-to-market accounting loophole, and Enron exploited it with gleeful abandon. They created a vast network of special-purpose entities, or SPEs, complex financial vehicles that were legally separate from Enron, but secretly controlled by Enron executives. The company would move its own money into these SPEs, use that money to buy assets from Enron at inflated prices, and then book the inflated price as profit. The SPEs would also take on Enron's debts, hiding the massive liabilities from the company's balance sheet. The deception was masterful. It was a shell game of epic proportions, run by a team of brilliant financiers, including the company's chief financial officer, Andrew Fastow. The auditors at Arthur Andersen, one of the big five accounting firms, were complicit, or at the very least, astonishingly negligent. They were paid millions of dollars in consulting fees by Enron, making them reluctant to question the company's accounting magic. The illusion could not last. In August of 2001, a whistleblower named Sharon Watkins, a vice president at Enron, sent an anonymous letter to Kenneth Lay warning him that the company was about to implode in a wave of accounting scandals. Lay, however, was either in denial or complicit. He did nothing. In October, Enron shocked the world by announcing a huge loss, writing down $591 million in asset value. It was the first crack in the dam. As investors began to scrutinize the financial statements, they realized the true extent of the fraud. The stock price, which had traded at over $90 a share, began a death spiral. It plummeted to pennies. On December 2, 2001, Enron filed for Chapter 11 bankruptcy, the largest bankruptcy in American history at the time. The company was worth nothing. The employees, who had been encouraged to invest their retirement savings in Enron stock, lost their entire nest eggs. Thousands of people were left destitute. The fallout was catastrophic. The criminal investigations were swift. Jeff Skilling, Kenneth Lay, and Andrew Fastow were indicted on multiple counts of fraud, conspiracy, and insider trading. Fastow cut a deal and testified against his former bosses. Skilling was convicted and sentenced to 24 years in prison, a sentence that was later reduced on appeal. Kenneth Lay was convicted but died of a heart attack before he could be sentenced. Arthur Andersen, the accounting firm that had certified Enron's books, was convicted of obstruction of justice. The conviction effectively destroyed the firm, ending its 130-year history. The Enron scandal was the catalyst for the most sweeping financial reform legislation since the Great Depression. Congress passed the Sarbanes-Oxley Act in 2002, a law that imposed strict new rules on corporate accounting, requiring CEOs to personally certify the accuracy of their financial statements and creating a new oversight board for the accounting industry. Enron was a tragedy of greed, a testament to the dangers of deregulation and the corruption that can fester in an environment of unchecked ambition. It taught the world that the numbers on a balance sheet are only as reliable as the integrity of the people who wrote them.